broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. And just in case if you're wondering and rubbing your eyes thinking whether it's Monday, well, it is not. The weekend is still there. It's a Saturday morning, but we're trading the full session. Normal markets today. Guys, hi, morning.
Hi, good morning, Prashant. Morning,
You're
Nigel.
the parents, Sonia.
I don't know what to say anymore. I mean, we're trading on a Saturday. I don't know who's watching us. There's suddenly a holiday on Monday. Things are all over the place. I mean, I'm sure I echo the pain of so many people out there. But, you know, it is bizarre what has happened in the last 24 hours. Of course, the markets need to make up for that holiday that we suddenly have on Monday. Be that as it may, full trading day today. I don't know who's happy about that.
You would have wanted a little bit more planning that goes in the system. But guys, we've got a trading session, so let's get straight to the action.
Oh, absolutely. And there will be action, but maybe a little bit less.
Much
Yes,
less.
much
It'll be
less.
much lower because FIs are going to be non-existent.
Domestic mutual funds are not
funds
there,
also
yeah.
I
as
think a lot
well.
of people also will hang back and take it easy.
Yeah, you
because
have
it's,
to.
you know, it's a Saturday.
And suddenly you have a long weekend, right? A lot of people will
Mondays,
have
Mondays.
Mondays.
Absolutely. So let's just quickly run you through what you need to know as we begin another session, because it is a normal session. I'll start with where we left off yesterday, right? I mean, the Nifty, and we made this point yesterday, same time, Friday morning, that we are likely to see a bounce. Most likely, you know, this midweek sell-off that we had, that 500-point sell-off that we had, or rather, it was a 600-point two-day sell-off, that for now maybe starts to halt, and we get a decent, meaningful pullback. We got that. But, you know, the only kind of complaint is that both the Nifty and especially the Nifty Bank, after opening, they did not build on those gains. There were no incremental gains to be had. The Nifty Bank actually sold off and it ended slightly in the red. So there was nothing on the Nifty Bank left by the time we closed at 3:30 yesterday. Now, the question, I think, still, which many are asking is that two-day kind of fall completely behind? Can we rule that out, or will it come back in some fashion later? Well, if you want to sort of pick on the answer from global markets, it's a positive one. It's certainly positive. The S&P 500 has made a new record high, closing high, for the first time in 2 years. That's got to count for something, the S&P 500. The index went up about 1.2%. The NASDAQ was up about 1.7% as well. So equity markets overnight giving a positive thumbs up. We had some data which I think propelled markets higher. This is the Michigan Consumer Sentiment. It's a survey, basically, if we can move the graphics along, which beat expectations, beat estimates. Inflation forecasts fell, and it was a surprise, right? But this is exactly what markets were looking for, which is that consumer sentiment remains upbeat and consumers' expectations of where inflation will be now and 6 months from now. That's what the survey asks consumers to sort of say. That falls. So it's like I mean, I don't want to use the oft-repeated word Goldilocks, but this is what markets wanted. And if you look at it, yields cooled off after the data came through and markets actually pulled higher. This was the trigger. You still had Fed officials, and we'll put out details of this a little later, who came back. Two Fed officials who came back and said that we don't want to declare victory on inflation before we actually get to the 2% mark. And another one who, again, sort of emphasized the fact that we've got to be careful, we've got to be calibrated. It's kind of pushing back on that early rate cut narrative, or rather hopes. So you also had the March Fed rate cut odds, market pricing of which fell to 42.5%. The quantum in any case has fallen from 25 to 15 basis points, but the odds also fell to 42.5%. Now, just to circle back and answer that question, right, whether this is it and the market now stretches higher. So just a couple of levels. Yesterday's high was 21,670. The first resistance, which I was hoping that we'll get to it yesterday itself, we did not. We fell about 30 points short, is this 50% retracement of the two-day fall, the 600-point two-day fall, which stands at 21,705. So that's level number one. If we take that out, the next resistance is exactly 100 points out, 21,800, 21,804 to be precise, which is the 61.8% retracement of the two-day fall that we had. So to my mind, I mean, if you are able to take these two levels out, 21,700, 21,800, and stay above it, then we can start to think about the market extending these sort of gains on the upside and maybe look at the previous highs, etc. But that's the first hurdle, the two hurdles to take out. On the downside, I mean, I think, we'll be well served if this recent low which we saw, which is 21,285, does not come into the picture anytime soon, or we don't see it. It should be protected. That's the point. Nifty Bank, similar picture. It's much weaker. I mean, the problem for the Nifty is that it's got no help from banks at all. Yesterday's high was 46,430. The first retracement is the 38% there, which is 46,529. We never got there. I mean, actually, as I said, the Nifty Bank ended lower. Bank Nifty, the next resistance is the 50% retrace, 61.8% retracement, which is 46,868. And on the downside, the Nifty Bank should protect the low that we saw, which is 45,430. That's Thursday's low coming into play. No point looking at the GIFT Nifty, etc., because, I mean, there's not very much activity. Global markets are not trading, so no indication from that. But given the US handoff, etc., that we have and the momentum that we saw yesterday, I mean, it should be a positive kind of a start, although action through the course of the day expected to be extremely muted. Sonia.
Oh, absolutely. And for today, at least, we have a positive handover from the US markets, which is looking very good. And the domestic cues are also not too bad. So let's get straight to that, right? The S&P 500 is now officially in a bull market after the kind of run-up that we've seen this year. And, of course, the big up move that we had in 2023 as well. All-time highs, fresh all-time highs for the S&P 500. We also had very strong bounce back from a lot of the technology stocks in the US market. So there was a comeback there. For our own markets, we had stable set of numbers coming from Reliance yesterday, in case you missed it. The Reliance retail numbers were stellar as can be. Jio was also quite a stable set. The oil to chemical business had a bit of an impact, but that's also because of the planned shutdown, maintenance shutdown that the company undertook. So good numbers over there. HUL could really sour sentiment in the consumption space today, in the FMCG space. The numbers were below estimates. The company says they see demand challenges, and the FMCG sector could perhaps take a step back because of that. There was big buying from DIIs yesterday, up almost 2,600 crores, while FIs continue to sell, and that has been a bit of a pain pocket for the market, down almost about 3,700 crores. Couple of more numbers that I'm watching, and we'll get to more details, but Paytm would be interesting. It has seen a decent amount of run-up, and the numbers are good. They've been improving. The losses have gone down. The EBITDA has improved in Q3. So that's another stock that I'm going to look at. Remember, since today is a non-business day, domestic mutual funds will not participate. All the redemptions will happen on Tuesday. So in that context, volumes will be on the lower side. FIs are also not going to participate. It may not be too much of a directional move. But yes, plenty of stocks in focus. You have ICICI Kotak that report today as well.
Well, as I heard you and Prashant, obviously it was valid market information, but I was still coming to terms that it's a Saturday morning. We're live on television. The markets are going to start. Wow, right, guys?
So, when I was driving to work today, generally you see people like scurrying, school buses and all of that. Today there were people taking their morning walks and cycling on the road, and I'm driving full speed, getting out.
But it was at least clear, right? And it was a beautiful morning. It's nice and cool here in Mumbai. I put my muffler on. I said, let's put up the style quotient. Let's enjoy it, right? A nice ride to work, 12
Might
kilometers.
as well enjoy it while you're at it.
Let's get back to the market action then, because that's what we are here for. So yesterday you had the Nifty. Well, it put on closer to 150 points. You'll be happy about that. But the intraday chart of the Nifty Bank, you just put up a split screen on the screen. It'll tell you the picture. Yeah, that's the picture. And let's pull up another chart as well. For the past week, you'll just see that the Nifty ended down only around 1%. Not too bad, yeah. Because HDFC Bank, the star of the market, or the heaviest weight in there, that's taken 11% cut. Just take a look at. So actually, at the X of HDFC Bank, the markets have done very, very well. But that's a bit of a problem pocket. So you're hoping at around this 52-week low of around 1,460 odd, you see some kind of support coming on HDFC Bank. And I think, the downside could be fairly limited from these price levels, from this 52-week low. Let's see how that goes. FIs, what do? They added shorts yet again. And now the shorts in the system have gone up to close to around 53% approximately. And in terms of the net long positions, you pull up a chart. We started this series with close to around 80,000 contracts were on the long side. And the bar graph will tell you the picture. Now we're net short, close to around 16,000 short contracts in the system. Remember, in the past, we've gone, much higher on the short side. But I like some shorts in the system. Given the kind of selling we've seen from the FIs, at some point of time, those shorts will have to cover up. So maybe we see a few days of short addition. Not today, obviously, because they'll not be existent. What do the options data look like? Well, 21,600, 21,500 put. Both of them did see a fair bit of open interest breakup. So that's why, you just try to pull up the levels then. You have the 20 DMA. We could breach that in today's trading session in all probability. You want it to decisively be conquered. The 50 DMA, well, that's far deeper. And I spoke to a lot of technical guys, not just yesterday, but over the last few days. And no one's talking about life below the 20,800, 20,900 approximately. The near-term support, though, going by the options data, is 21,400, 21,450 because the kind of put writing that we did see. The Nifty Bank, that's pat in the level between the 50 as well as the 100 DMA. So both those two are your goalposts for you. Hopefully, the banking numbers that come out today are not too bad or maybe have a bit of a positive surprise, because otherwise, this Nifty Bank, from being nearly 49,000 odd, if you just pull up a chart, you'll see that it's come down to close to around this 46, 45,500 odd levels. But that's a crucial level on the downside. We managed to defend it intraday in the last week itself. So let's hopefully, defend that and try to move up. But guys, Saturday morning.
Okay, markets open today as per normal hours in case you've joined in late, and Jan 22nd is going to be a holiday for the markets. So today we trade the entire day. We have lots of stock-specific action to track for you today. We'll get to it in just a bit in our special Top 10 segment. We're looking at Reliance, Paytm, Tata Steel and CESC that are on our radar on the back of positive news flow. There's HUL, RBL Bank, Fortis, Suntech Realty, Tejas Networks and Credit Access Grameen. That's on our radar on the back of negative news flow, largely because of earnings reactions that have come through. So plenty of stocks to talk about. But as the Federal Reserve gears up for its next meeting that happens on the 30th and 31st of January, the big question that investors have is, when will the Fed start cutting rates? Let's listen into what the Chicago Fed President Austin Goolsbee has to say on the Fed's rate trajectory going forward.
2023, we're going to look back. You have to say, as far as the Fed's dual mandate goes of maximizing employment and restabilizing prices, we've made a lot of progress on the golden path in 2023. I don't like tying my hands when we still have weeks of data, and the way the Fed Open Market Committee operates is we go meeting by meeting. So let's not pre-commit ourselves on hypotheticals of what we would do in 3 meetings if we saw XYZ in the data. Let's take the long view. If we continue to make surprising progress faster than was forecast on inflation, then we have to take that into account in determining the level of restrictiveness.
Okay, well, that's opinion coming in from Fed officials. We have Ed Yardini, president at Yardini Research, joining us. Ed, great to have you with us here. Thanks very much and congratulations. We got the benchmark S&P at record highs as of yesterday. So it's looking good. And I think, if I remember correctly, you got decent upside levels from here. When we spoke with you at the beginning of the year, end of last year, you just want to sort of run us through that again?
Yeah, I'm looking for the S&P 500 to get up to 5,400 by the end of the year and 6,000 next year. So I think we're in a bull market. I've thought that since October 2022.
We are in the US markets definitely is in a bull market with the way the markets are moving. Even back here in India, actually, Ed, it's been pretty solid. We've had a couple of volatile phases, but now we're heading into big events like the election. There's the budget as well, the vote on account. How do you see the Indian market shape up?
Well, I think in the global competition for global investors, India's been doing extremely well. And I think part of that is because India is a successful economy. It's an economy that has a lot of relatively young workers. And it's an economy that has a lot of upside potential. I mean, there's still a lot of work to be done, for example, with the infrastructure. But compared to China is really what's going on here. A lot of investors are not going back into China, even though China's gotten cheaper and cheaper. And as India's market's gone up, China's market's gone down, which I think signals that investors believe that the property bubble that's burst in China is going to continue to depress that economy, and that their underlying demographics of aging population is another negative. So India is kind of winning the race here in terms of emerging markets in global portfolios.
Well, indeed. Morning, Ed. Good to see you. And, one would say we're expensive, but going by the points that you put down so beautifully, well, we're expensive for a reason. because, the demographics of the earnings growth as well to look ahead. Ed, the last time we chatted, you gave us your view in terms of rate cuts, and you said you're expecting something only in the second half of the year. So that's one cue, and we've got your view on that. But what about the U.S. presidential elections? It appears, as of now at least, that maybe the Republicans could be in with a good chance. How do you see that panning out and its impact on the stock markets?
Well, you never can tell with politics. You never can tell with whether the Democrats or the Republicans are going to have the White House. Right now, it looks like it's going to be the same old horses in the old race, and that's Trump and Biden. And both of them are very controversial figures. They're very partisan. Half of the people like them, and one candidate, and half dislike the other one. So, it's kind of a 50-50 mix here in terms of partisanship. It's been my observation that the U.S. economy and stock market have been doing remarkably well for the past few years, despite Washington. That's my attitude towards Washington, is that it's really only an obstacle for doing business, but somehow or other, Americans managed to do a good job of keeping the economy moving forward. So I'm pleased about that. With regards to interest rates, I haven't been expecting a big drop in the federal funds rate. I think the economy is going to remain very, very strong.
Ed, I would argue, and I don't know if you agree with that, is that you said that despite politics, right, markets have been doing well, but actually you can sort of argue the other side as well, which is that it doesn't matter Republicans or Democrats, left or right or whatever. One thing everyone has understood is that you've got to keep the markets happy. Markets got to be up. And that's an important kind of a signal, which is important for the real economy,
Sure.
et cetera, et cetera. You'd agree with that, Ed?
Well, I think at the end of the day, politics doesn't matter as much as the fundamentals of the economy. And the fundamentals of the economy are certainly influenced by fiscal and monetary policy, but they are mostly driven by the corporate sector, the business sector, and workers, and that they continue to produce better and better economic growth, record highs in real GDP, economy growing better than expected. And guess what? No recession. No recession in 2022, 2023. I don't think we're going to have one in 2024.
Yeah.
Okay, well, that is a strong statement and a very ambitious one at that. No recession in 2024 either, after what we've seen in 2022 and 2023. Hope that plays out, for the benefit of the bulls at least. Let's thank you on that note, Ed. Have a good weekend, and thanks for joining us on a Saturday. Let's slip into a quick break. On the other side, our entire team is also with us to give us a list of top 10 stocks. Stay tuned.
What's your favorite?
All right, welcome back to Bazaar Morning Call. We have a full session of trade today, and we have a full list of stocks to talk about. So let's get straight to it. First up, of course, Reliance will be in focus, and you're seeing a lot of the brokerage commentary on your screen. But in the meantime, let me just take you through the key numbers. Now, this time around, there was growth across key operating businesses. The oil to chemicals business was under a bit of pressure, but that's also because of a planned maintenance shutdown. The consumer-facing businesses of Reliance is doing very well this time around. So if you look at the retail business, it was a stellar growth over there. The retail business EBITDA was up 31% year-on-year. Oil and gas posted its highest ever quarterly EBITDA this time. KG-D6 is now contributing to 30%, by the way, of India's gas production. Jio business was quite steady on all parameters. Revenue growth was 2.5% quarter-on-quarter. There was strong subscriber addition, and that's what drove the top-line growth as well. The EBITDA margins for Jio have been stable for the last 5 quarters at 52.4%, and the ARPUs increased 2% year-on-year, almost at 182 rupees because of a better subscriber mix. The subscriber base as well has inched up higher to 470 million. So the consolidated numbers will come up for you on your screen. Largely a stable set of numbers, you'd have to say. The EBITDA margins have improved quarter on quarter. And as I said, the oil to chemical business was impacted because of the planned maintenance shutdown. But standard disclaimer, Reliance Industries is the owner of the channel that you're watching and will be reacting to their numbers today.
Okay, all right. Well, that one has been holding one end up. So let's see how that goes. But Mangalam joins in as well. And when, we introduced everyone, Mangalam, you were looking the most upset. But maybe you had a big plan on Saturday, but HUL's numbers were more disappointing, I think.
Well, yeah, I was looking forward to the rest, actually, post HUL and Reliance numbers. But tell you what, HUL numbers have been weak. They've been weak for the last 4 quarters. And this time around as well, not much was expected, but the company disappointed on that as well. Revenues shy of that 15,200 crore mark. The street was working with a number closer to 15,400 crore. EBITDA 3540 crores. The street was working again with a number of 3,700 crores. As a result of which the net profit was below expectations as well. Volume growth at 2% was in line with measly expectations of 2 to 3% as well. Gross margins, they improved by 400 basis points. But there was no improvement in the EBITDA margin because the company increased their ad spends by about 260 basis points across all their segments, be it home care, beauty and personal care. Revenues declined by about 1%, whereas we saw a 1% increase in food and refreshments itself. The management said the environment is challenging. They are navigating through this. And the couple of parameters that they'll be watching out for is rural income growth and how winter crop yields come out for them to decide whether there is some recovery in rural India or not. But for now, expect the stock to be in the red. It has been an underperformer, may continue to underperform until macro challenges are away.
All right. Mangalam, thanks very much for that. We'll, of course, play out Mangalam's chat with the HUL management a little later here on the program as well. But let's move on and talk about RBL Bank. Abhishek is here with details on this one. Abhishek, morning.
Morning, Prashant. So RBL Bank numbers on slippages actually disappointed. Slippages were at 666 crore, which is up more than 23% quarter on quarter. The annualized slippage ratio has now crossed the 3% level, 3.33 versus 2.84% in the previous quarter. Now, gross NPA and value-wise rose by more than 4%. However, in terms of percentage, gross NPA ratio has remained flat on a sequential basis owing to loan growth. Net interest margin was at 5.52% versus 5.54%. So that's another good point to take away. In terms of the performance versus our poll, the NII was in line with our poll. However, on account of one-off provision that they made with respect to AIF of about rupees 115 crores, the PAT came in below our poll. Back to you.
Okay, thanks a lot, Abhishek, for that. Well, Paytm also came out with its numbers. How did it look this time?
Well, Sonia, EBITDA improvement continued. Loans have declined on a sequential basis, which is a negative surprise. Total income was up 40% YOY and about 12.6% sequentially. The EBITDA, that increased by 7x on a YOY basis due to small base or lower base in last year, same quarter. And sequentially, it improved by 43% on a sequential basis. Contribution profit margin, that declined sharply sequentially to 53.3 versus 56.6% in the previous quarter. Net loss, that continued to narrow down. It is now at 222 crores versus 392 crore on a YY basis and about 292 crore on a sequential basis. The gross merchandise value, that's increased by more than 25% YOY and about 7.7% sequentially. The value of loan disbursed, that declined sequentially by 4.3%. Number of loans also declined sequentially by 12.9%. Back to you.
Okay, all right, Abhishek, and you've got a busy day with the other banking names as well that will be coming out, so we look forward to your analysis later on. But I'm looking at Tata Steel. Well, yesterday they announced, their plans with regard to the UK operations, and it's a step in the right direction, so expect the stock to react positively. Now, they're saying that they'll commence statutory consultation as part of its plan to transform the UK business that they've already announced. Now, they've given a couple of numbers now. Up to 2,800 employees will be affected owing to this, and they propose to commit in excess of 130 million euros as a support package for these affected employees. The UK government, remember, had already committed up to around 500 million pounds to enable the transformation, and they are committing. Tata Steel has already committed around 750. So that's pretty good news. So expecting basically the step in the right direction. So expect the stock to react positively. Yesterday it ended high with a gain of around 2.5%. But let's hop across to Ekta. Ekta, tell us about Fortis.
Well, yes, I expect Fortis to probably show some amount of negative reaction today because Agilus Diagnostics, which is basically their subsidiary in the diagnostic space, has received a notice on Jan 18th from the anti-corruption branch of Delhi. This is in respect to the alleged anomalies in diagnostic tests conducted in the Aam Aadmi Mohalla clinic, and they have sought certain documents and information from Agilus. Agilus has indicated that they've rendered services worth around 20.4 crores as of December 31st, 2023. The services are less than 2% of their consolidated revenue, and as of date, Agilus has only received a sum of around 3.3 crores from the Directorate General of Health Services of the Delhi government. Agilus continue to provide services in interest of the public at large. They sent various notices to the DGHS requesting release of outstanding payment of pending dues, and they have indicated that they just picked up samples, tested, carried out billing and reporting within the agreement. So I expect the reaction to probably be very limited for Fortis, simply because the financial impact is very limited of this.
All right. Thanks a lot for that, Ekta. That's on Fortis Healthcare. But we also have Suntech Realty that you should be watching today. Sonal is here to tell us the latest on that. Sonal, over to you.
Good morning, Sonia. Well, usually for real estate companies, we have to look at the pre-sales and volumes. But surprisingly, this time, they have not given it in the presentation yet. The presentation is not out after their numbers. So we do have the P&L where it looks like their revenues are down 52%. It is an EBITDA loss of 15.6 crore rupees versus an EBITDA of 18 crore rupees. They have a loss this time of 9 crores versus profit of 2 crores. But it is not entirely the way we should be looking at real estate companies. So we'll await investor presentation details where they will be giving the launches, the pipeline and the operation update for the quarter as well.
Okay, all right. Sonal, thanks very much for that. Let's move across and talk about Tejas Networks. Rima is here with details on this one. Rima.
Hi, good morning. So Tejas Networks has reported very strong revenue growth, but EBITDA losses for the company have expanded. So the company's top line growth stands at 41% quarter on quarter, and year on year, it's a growth of more than 100%. If you remember, recently the company had won a very large BSNL deal. So as the company executes on this BSNL deal, they are procuring a lot of components, they're investing in R&D, and that's the reason why the EBITDA for the company this time has come in as a loss of 7.5 crore, and even at the bottom line there is a loss of about 45 crore. The company has said that there is increased inventory that they are sitting on. As I said, it's maybe largely on account of procuring all the equipments which is required to execute the large BSNL order, and the order book for the company is in excess of 9,000 crore rupees. So the inventory this quarter stands at 2,683 crores. Back to you.
Okay, all right. Thanks a lot for that, Rima. Well, let's go back to Sonal. She's here to tell us about CESC. Sonal?
Well, for CESC, the numbers look decent on a sequential basis. There was a revenue growth of 2%. EBITDA grew 5% to come in at 963 crore rupees. However, profits were down 10% because of some level of higher expenses by the company as well. But the generation volumes, they were good. They were up 28% to come in at 1,535 million units. So that worked well for the company. So expect the stock to be in the green.
All right, Sonal, thanks a lot for that. Well, Credit Access Grameen also came out with its numbers yesterday post-market hours. Let's find out how it looked. Abhishek is here with the fine print. Abhishek, over to you.
Well, Sonia, amongst lenders, microfinance seems to be the painful portfolio in Q3 FY24, with asset quality deteriorating across pan-India, like Tamil Nadu floods impacting the book of some of the lenders. This time, for Credit Access Grameen, the western part of India has actually impacted the asset quality. Gross NPA value-wise has increased more than 32.5% sequentially. The NII growth remained healthy at 48.5% YOY and more than 5% sequentially. Provisions were up 31.7% quarter-on-quarter due to deterioration in asset quality. PAT has increased by 63% YOY and by just 1.2% on a sequential basis. Disbursements remain tepid in terms of YOY performance, growing at just 10% YOY. However, sequential growth in disbursements were strong at about 7.5%. AUM growth remained healthy at 31.5% YOY and about 4% sequentially. So expect a red tick on the stock today on account of the deterioration in asset quality that you have seen. Back to you.
Got it. All right. Thanks a lot for that. Thanks to our entire team, actually, for giving us all of the data this morning. Here's a quick recap of our top stocks. Stocks with positive news flow. There's Reliance, Paytm, Tata Steel and CESC. While stocks with negative news flow, HUL, RBL Bank, Fortis Healthcare, Suntech Realty, Tejas Networks and Credit Access Grameen. Take a quick break. On the other side, Prakash Diwan will be with us to give us some fundamental stock analysis. We have lots to discuss. So don't go anywhere.
Welcome back. Good morning, and it's a Saturday morning. Hope you're having a good one. Prakash Sivan joins us on the show. Hi, Prakash. Good morning. How do you feel this morning? Good, I'm guessing.
I know what you're going to hear, but it's okay. I mean, it's just that we got to live with that shift in terms of the days that we work. So Monday being off, possibly will probably be a decent enough compensation to the hard work you're doing in today.
Oh. Okay, Prakash. So you've all revved up the engine then. So you're set. Let's get cracking. Reliance Industries. How do the numbers look? Sonia told us it was looking pretty good.
Oh yes, of course. I think what people need to understand, and I'm sure people will, is that on a scale like this to continue to grow, and now that the transition is very evident and absolutely well established, there's no ambiguity around that. The customer-facing businesses have actually marched ahead with such promise that I would be surprised if retail starts getting discussed with a valuation which is, which is at par with global comparatives in terms of valuation metrics. The scale that they offer, the kind of price points that they straddle, the kind of product range which is covered is just phenomenal. So my sense is this is kind of these numbers actually very clearly tell you there's something which should happen in terms of a value unlocking on the retail side to begin with, and then possibly the digital business.
Okay, absolutely. I mean, the only thing, with Reliance, I was going through some of the brokerage notes. The capex has fallen to an 8-quarter low this time. And this is the slowest investment capex that the company has seen in the last 2 years. So that's just one thing to point out. But of course, consumer-facing businesses are doing extremely well, so no problems about that. Prakash, hi, good morning. Never thought I'd say this to you on a Saturday morning, but we just saw each other less than 12 hours ago talking about Reliance's numbers, and now here we are. We're also going to talk about HUL's numbers, right? Because those were disappointing and there are demand challenges. But as an investor in HUL, what do you do now?
Good morning, Sonia. So, I do agree. There is definitely something amiss in terms of HUL, and I think that kind of represents the entire FMCG side, except for a Tata Consumer or a Godrej Consumer, which have different reasons to grow and kind of get attractive. I think the core businesses in the FMCG space are finding volume growth to be very difficult. So whatever they did in terms of price increases and grammage reduction and all of that has kind of played out. There's not much left in that war chest. Most of the FMCG players will actually now have to depend on demand resurrection, and that could probably be still painfully away. At least 2 quarters post the monsoon, if things look different, there could be something else. So I would, if I'm an investor in HUL, I would probably move to an ITC because there are certain triggers that are very imminent out there, Sonia. Particularly the hotels business getting demerged out of that, carved out, will probably be a very positive spin-off. So you'll finally see a very clear FMCG-led business and, of course, hospitality business getting separated, and there'll be value accretion in both. So HUL probably doesn't have much of firepower at this point in time. So I would, but it could surprise us if the demand numbers start looking up because the base has been made. It's absolutely at a bottom.
Okay, what about Paytm? This time the numbers are good, the EBITDA has improved, the losses have gone down, and that stock has sort of come back into investors' radar. At this price, is it still a buy?
So it depends on what kind of timeline you attribute to this kind of a thing in terms of unlocking a value. So there were restrictions by the RBI that kind of brought things to a little bit of a slowdown. But I think their metrics have definitely been improving. So what happened to, let's say, Zomato when they realized that path to profitability is something which the onus is on them and not on the market or not on the consumer segment? That's exactly what Paytm is also doing. And remember, Paytm has a lot of other optionalities, Sonia. I mean, it's not just the payment transaction business. It's not just the loan business. They also have the POS business, which I've seen, as I keep pointing out, as a very promising area where they could kind of have some sort of a sway. So there will be all of these which will start adding to it, and then things start looking very different. So if you are willing to hold on for at least a couple of years, because the turnaround could take some time, it's very gradual, very slow, but it's distinctly finitely there. So it depends on that. But even if you don't buy it right now, I'm sure you're not going to miss out on too much of an upside. So let me also add that caveat.
Okay, all right. Prakash, what about the largest weight on the index, HDFC Bank? You know, how do you approach it? Added on this 1,470 rupees odd. There are lack of positive triggers, mind you. And the next few quarters, you know, we'll still be waiting by for management commentary. But at 1,470, if you give a value of say 230, 250 rupees at least to its subsidiaries, you're having the core business at around 1,250 rupees, very, very roughly. And they're going to do an EPS after being scaled down at around 97 rupees. You're getting one of the largest banks at just, you know, sub 13 times its earnings. Valuations will support, lack of positive triggers, yes. But do you think downside is limited from here?
So Nigel, you know, that's what happened. The market never obliges with a very linear, fair kind of a growth for any of the stocks. I mean, you have extremes of pessimism and this greed, which kind of between which we prevail, right? So what's happened is the expectations were very high when we went into earnings from HDFC, and people were woken up to the reality that it's just been a quarter for the merged entity to have flexed itself. They'd set the very clear expectation in terms of what, you know, waiting for at least 3-4 quarters before the bad loans would kind of get ingested and digested and then kind of moved on. But, you know, one thing, the respite for HDFC, in my view, comes from, apart from, of course, the valuation being so soft and benign, comes from the statement that the RBI governor made in the interview Shireen had with him, you know, in Davos. So where he said there's nothing like a very clear, defined CD ratio that's been, you know, attributed to the sector or been assigned to some, or been expected out of a company or a bank. Now, which means that, you know, all this liquidity related, CD ratio related issues that we felt that the deposits aren't growing as much as credit has grown will probably come to rest. And in the meanwhile, the branch expansion that's underway could probably start changing the profile in terms of what they can mop up as deposits as the merged entity. So there's lots that probably time would heal. If you buy at these levels, to be honest, there's absolutely no risk on the downside. How much more it can go, the most of the selling's been done. And if inflows keep coming, which you would expect if things look up for the next couple of months, by March end, HDFC and some of the other banks would look very differently strong. So I'm sure there's more value than what it was at 1550, 1600 than, you know, as compared to what today. So look at it from that perspective, but give it time. Don't expect just to correct back to 1700 in a hurry.
All right. Well, let's continue talking about some numbers and we'll come back to you, Prakash, in a bit. HUL, right, reported a weak set of numbers. The EBITDA was flat despite a 400 basis points gross margin improvement. Mangalam actually quizzed the management of HUL at the Q3 earnings call, began by asking them about when they expect a significant recovery in the volume growth. The commentary was a bit sober as well. Listen into what they had to say.
So if you disaggregate our growth, and as you said, it has been in low single digits in the last couple of quarters. The fact is that we're coming off a inflation-deflation cycle where clearly the response to the investments and prices is taking some time to come on account of a few macro factors, which we have to also accept as a part of the context we operate the FMCG business in. For instance, the slow recovery in rural, although of course urban continues to be resilient. So we operate within a certain context where we are continuing to be competitive. And as Ritesh mentioned, 60% or thereabouts of our business is still winning market shares. And we are coming off on a very, very high base of market shares of the last 2 years. So we remain strong, competitive, even though the top line numbers are what they are optically. As far as volumes are concerned, if you disaggregate our volumes by our three businesses, our home care, our beauty and personal care businesses are growing in single digits, in mid-single digits, which is our second quarter in a row. So where we have taken prices down, we already start to see a price response to volume, and volumes are coming back, including, of course, being helped by the slow recovery in rural. On food and refreshment is where we have negative volumes. That brings down the total number. And that is largely because a lot of that, the categories we operate in, food and refreshments, still have faced high levels of inflation. To name an example, coffee, even on HFD. And in tea, we are seeing some downgradation. So it's still coming on the back of high prices, although the increase in prices is beginning to sort of narrow and stop. So we do expect over a period of time this will lap. But as we speak, food and refreshment is where we do see the volume drag. Although the heartening fact is that we remain very competitive on value share across all our big categories in food and refreshment. So that is something that gives me quite a lot of confidence that what we're doing fundamentally are absolutely the right things. We are investing behind our brands. Our brand power is strong. Advertising, which had come down over the last several years of high inflation, is back. We are at very competitive levels of investment. Brands have good product quality, and I feel that our distribution and operational grip is tight. So we are going to come out stronger from this inflation-deflation cycle. And all we are doing around building our business for the future, such as investing in beauty care, capability, and all of that is going to basically pay off in good stead. So I feel quite optimistic that all of these investments are in the right places, and we will see, as macros tend to improve, some turn in volumes as well. I would ask Ritesh then now to complete the question on the margin and how exactly the shape of investments that we are currently choosing.
Sure. And Mungib, just to further build on the few more elements. So as Rohit mentioned, the home and personal care and beauty and entire business put together has grown mid-single digit. Remember, this is 3/4 of our business. So already 75% of the business has registered mid-single digit volume growth. And it's the foods and refreshment, which is the quarter of the business, which Rohit explained, given commodity inflation, given a very different commodity cycle, which is where we've seen low single digit volume decline. And also, I want to call out the premium categories. If you look at beauty premium categories, if I look at the plus range within Horlicks, again, the premium part of HFD. If I look at newer formats, mask, serum, if I look at innovations like mayonnaise peanut butter. So these parts of the businesses are already showing double-digit volume momentum. So there are parts of the business which have shown momentum very different. And of course, certain parts of the business are dependent upon the realities of inflation, which is a different cycle compared to the rest of the business.
All right, we already got the view with regard to HUL from Prakash. But Prakash, what's your view on RBL Bank? We'll be chatting with the management later on in the show. But did you have a look at those numbers and how would you view this stock? You know, one point of time it was $100, $120. That was a good entry point, but now it's closer to 300 rupees. So your view. Prakash, I think we need to unmute you. We would love to hear what you have to say.
Yeah, I said, RBL Bank cases that the valuations are such that it actually makes it more vulnerable to some sort of a correction. People are not going to like the fact that slippages are going from more than just one segment. It's not just credit cards, which was a culprit last time. It's, microfinance, which is kind of letting them down. So, and there's not much of a way they can grow at a pace which in a tight interest rate regime, which will be very significantly different. So there will be some sort of a punishment that it will probably get from these numbers. There's nothing which is very encouraging in any of the metrics, Nigel. So I would be cautious and look at where the larger private sector banks are trading. Right? Even if you don't look at the top four, you go to a step down and look at an index. There's nothing wrong with that. So you would rather buy something which is much more resilient as compared to something which kind of shakes your confidence every quarter. So I'm a believer. The bigger banks on the private sector are definitely something which you need to look at far more seriously than ever before.
Got it. All right. The other is I'm glad, it was a cue for me to ask you about the bigger banks in the private sector space, because last week, the biggest talking point was HDFC Bank, right? It was the biggest weekly fall in 3 years. The stock was down 10% last week. Hand on heart, don't you think this is a great opportunity to buy HDFC Bank despite all of the, volatility that we're seeing in numbers?
No, absolutely, Tanya. So as I said, where else will you get this kind of a valuation? Now, whether you want to buy HDFC Bank or not, that's the question. There's a lot of debate around why HDFC Bank at this valuation was, at the erstwhile valuation was so sought after as compared to some of the global banks like Bank of America and all of that. But people need to understand India is a very different market where this is one bank that has absolutely the right to win in terms of spreading itself, expanding itself. There have been technology letdowns which related letdown, which they are plugging, I'm sure. So, there's lots that's happening. So all of that takes time. It's a turnaround of sorts after the merger. Two giants coming together. It's not something very easy. The earth underneath is going to, shudder a bit. And then that's what's happened. So my sense is you buy into HDFC Bank with a slightly higher expectation, give it some rope. Don't expect it to turn around in just a couple of weeks or one quarter. So that's the whole idea. But I don't think things can go worse than where it is in terms of valuation, with all the subsidiary valuation also kind of built in, and they are growing so rapidly, be it asset management, insurance, general life, all of it. So I don't see why that would be such a big issue in terms of growth not going ahead.
Okay, all right. Prakash, request you to stay with us. We'll come back to you. We'll discuss a couple of more stocks. For the time being, slip in a short break. Mitesh as well as Kush, they're waiting for us. They'll give us some technical trades.
All right, we're getting set for Saturday morning. That's a working day. And the market, of course, is going to open in like less than 10 minutes from now. The pre-opening rate's going to kick in. We have Mitesh Thakkar and Kush Bora joining in. Guys, good morning and welcome to the show. Mitesh, this market has good cues, right? I mean, you have positive global cues. You have Monday that's off. So a long weekend for many. But you tell us, what's your view for today?
Good morning, Sonia. I think, we maintained that bouncing back from 21,300 was a good thing. And we might actually need a good consolidation before we pick up the energy to start getting into an uptrend again. Not breaking below 21,300, I think, for the next few days would be the key. And I think that looks like to be the case at least today, with the global cues on the stronger side or on the favorable side. I think today the levels to watch on the upside for the Nifty, 21,750 is the first level which I'm watching. And then the gap down which happened with the HDFC Bank numbers, which is closer to about levels of 21,950, 22,000. I think that would be a very significant supply point. So my sense is that at higher levels around 21,950, we'll see very strong supply emerge, and there's good buying around 21,300. So there could be a situation where in next about 6 to 10 sessions, we might actually be in this range. It will be a choppy one, but broadly, the markets will be slightly directional less and consolidate. Not a bad point, as long as we are holding about 21,300, buy on declines remains the strategy.
Absolutely. Gentlemen, morning. Kush, what are your thoughts this morning?
On the working Saturday or the markets?
Why don't you start with markets and then go on.
Sure. So, it might sound like to save some effort, Mitesh and I have exchanged notes. I can tell you we've not. Very similar view on the markets. Although I'm slightly bullish, the 20-day moving average might seem like, the first resistance as we saw yesterday. But for me, the stronger supply zone comes in at 21,750 and 21,800 kind of levels, where the Nifty spent a considerable time before sort of breaking up and, giving us a 22,000 move. So for me, 21,750, 800 is the kind of zone that I will watch for. And on the downside, as Mitesh said, I completely agree, 21,300 to in fact 21,200, that kind of zone. If that holds on, I think we should have a goodish kind of a January to end with. So I think for now, play the range. 21,800 is where I would book the profits if I've got a long position, and 21,300 is where I would look to buy again if the market slipped to those levels.
Okay, Kush, hi, good morning. What about individual stocks? What are you looking at? And I also want your thoughts on, Reliance, HUL. There could be some subdued moves here, but what do you do? Do you buy the dips?
Hi, Sonia. For sure. I mean, see, we've been bullish on Reliance for a while now, and we continue to remain. So there isn't anything on the chart suggesting that, this rally is perhaps coming to a halt. At best, we could see some sort of consolidation, I agree. But I think, from the perspective that Reliance is not typically a trader counter, it's an investor stock. You hold on to this one, whatever dip you get, anywhere, let's say close to 2,600, 2,650 also, if that happens, it's a good idea to buy. HUL is a slightly different setup right now, where the stock's actually not done too much in a while. So I would actually avoid this for now. In fact, just a quick word on HDFC. The stock's actually gone, into oversold territories on technical and derivative setup both. So I wouldn't be surprised to see a rebound on that. So play for a rebound on HDFC and then obviously does on the bank Nifty as well. As far as individual stocks go, two of them, again has been doing rather well. Why not stay with the leaders? So here we've got a buy view. 32.80, 33.50 are the targets that we're looking at. Another stock from the cash segment that we have on our radar. The stock's given a very clear breakout yesterday, and a volume backed one at that. So 515, 530 are the levels that I'm looking at. 490 is where I would place my stop loss.
Mitesh, what are your trades?
So I also have more of buy-side trades today, Prashant. Good morning. The first one is a buy on M&M with a stop at 1630 for targets of 1710. Escorts is also a buy. Keep a stop below 2945. Look for targets of 3075 and a buy on Keynes with a stop at 2080 for targets of around 2200. One sell call, that's Dixon. In the short term, the stock looks corrective. So keep a stop above 6170 and look for short positions to be taken with a target of 595.
All right, gentlemen, thank you very much for those trading ideas. But, I want to talk about the big, massive rally in PSUs as well. And Mitesh will do that in just a bit from now. We have to take a quick commercial break here. So let's do that. The pre-open should be with us when we return. And of course, we'll address the PSU rally from yesterday. Stay with us.
Copal.
I just want to quickly welcome back as the pre-open is coming up. But the big rally in public sector stocks is what I want to just spend a minute talking about and just asking Mitesh for his opinion. So, if you can have these stocks up, names like RVNL, IRFC, IRCON, it was a humongous move. I mean, actually, these are pre-open rates now, so they don't show you. I'll read out what the rates were. RVNL ended 20% higher yesterday. IRFC ended 10% higher yesterday. IRCON ended 12% higher in trade yesterday. And I'm going through the railway list first. RailTel ended 6% higher yesterday. You had RITES, which was up 6%. So, it was a very large move. And then the non-railway PSU stocks, non-railway, non-banks. So, HUDCO, 15% move. You had IRDA, which was up 10%. The changes you are seeing right now are the pre-open. So, I'm reading out yesterday's price action. New India Assurance, right? I mean, it was a 10% mover in trade. And then you look at names like NBCC. NBCC was up 8%. REC was up 7%. GIC-RE was 16% higher. So it was a humongous public sector move. We talk about banks and the larger banks, etc. But the PSU space really blew the lights out. Mitesh, just a comment on these and what are you still holding and what way one can take trades and just chartically, how is this pack looking?
So, Prashant, one, I have IRCTC as a big part of my portfolio, but that's been doing decently well as well, not as good as compared to some of the smaller names. But I think all these stocks, if you look at the chart structure, they are now in an uptrend for about 6 to 8 months. I mean, this last leg of upmove has started since last 6 to 8 months when we are seeing continuously a situation of prices making higher highs and higher lows. And that still, looks like continuing. While we are kind of now reaching overbought on weekly charts, there's no sign of stoppages yet. So my advice is that, just take the last swing load as your trailing stoppers and keep holding these stocks. This clearly, looks like a very euphoric kind of a movement when very exorbitant valuations can also be tested. I think, you have those phases in markets when these kind of things happen. Looks like that happening with the PSU name. And I still believe that some of them will keep on offering trading opportunities. For example, REC after a 4-week consolidation, when it had multiple highs around this 444, 445 mark, yesterday managed to just sneak above that and close above that. So if somebody wants to buy a fresh, keep a stop at 440. I think there's a good chance that we might see 490, 500 happening in this rally itself. So these will give you trading opportunities. And you need to wait for some consolidations and pullbacks to happen. But as of now, I think it looks like a market which is strongly enjoying a very euphoric uptrend, and typically it can last slightly beyond our imagination.
All right. Thanks a lot for that. Chandan Taparia is joining in. By the way, the currency market is also shut today and on Monday. So just an alert over there. Chandan Taparia of Motilal Oswal is going to give us some FNOQs for the day. Chandan, hi, good morning. Your thoughts on how to approach the markets today and what are the individual stocks you're looking at?
Good morning, Sonia. Thanks for having me. So if I look at the indices, Nifty is slightly positive, but Bank Nifty is slightly negative. So mixed cues in both the indices, given the scenario of selective banking stocks and outperformance in PSU and selective IT name. So as of now for Nifty, we have broader trading range in between 21,400 to 21,850. And for immediate point of view, if it manages to hold 21,500, we can attempt towards 21,750. So we need to play the range, but here we can go with buy on decline stance. But in Bank Nifty, picture is slightly different. We have seen a breakdown. Lower top, lower bottom is clearly visible. So we suggest to sell with the view that decline could be there. So Bank Nifty, we believe that weakness will be there until it holds below 46,250. It can drip down towards 45,000 kind of level. Now looking at the stock ideas, we are recommending buy on BHEL. We have seen a good movement in most of the CPSC name. Most of the PSU stocks are doing well. We are positive on the power, energy, railway. So first it is buy on BHEL. This stock is up and above. At 12 years breakout level, major trend is positive. It is making higher top, higher bottom. So recommending to buy BHEL with a stop loss of 214 and expecting a run up to us 238 level. Second trading idea, there is buy on REC Limited. We are positive on the Nifty CPSE, and we believe that CPSE index itself can rally by 15 to 25%. So most of the power stocks are likely to do well. REC has seen good momentum in last couple of months, and now after a consolidation of last 25 days, it is all set to give the fresh breakout. It managed to give the closing above 450. Longs are added, so recommend to buy with support of 441 and expecting it to move to us 475. Last trading idea, that is not least, that is buy on Indian Hotel. Entire sector is set for a massive run up given the positive sentiment in the country. Indian Hotel is making higher tops, higher bottom. Previous resistance are turning as a support. We have seen fresh breakout and higher tops, higher bottom the weekly as well. So recommending to buy on Indian Hotel with support of 470 and stock has potential to rally by 5 to 7% towards 510 zone.
All right. Thanks a lot for that. Have a great day. Have a good weekend. By the way, the pre-opening session is kicked in, and one of the numbers to look at will be Reliance Industries. So let's get straight to it. The operating performance has been good across all verticals. There was a maintenance shutdown in the oil to chemicals business, because of which those numbers were slightly lower than estimates. But let's take a look at what brokerages are saying. Morgan Stanley has an overweight on the stock. They have a target price of 28.21. They say the results were decent, but Reliance reported the slowest investment capex in the last 2 years. Gas production is what drove an earnings beat for the company this time, and the debt was on the flattish side, which was good. CLSA has a buy with a target price of 3,060. They say capex falls to an 8-quarter low this time. Macquarie has a neutral with a target price of 2,450. They say the key positives this time was that the retail revenue growth was very strong, margins were very good over there, and it was a solid Jio subscriber addition that they saw. Nomura has a buy with a target price of 3,165. They say the most important thing is that the Reliance has seen a sustained performance across their verticals, a healthy growth of the consumer businesses, and the sharp uptick in upstream as well. And finally, Jefferies has a buy with a target price of 3,140. I think the moot point is that consumer businesses are doing very well. They talk about how there's a healthy subscriber addition in the Jio business. But Prabal Sen joins in. He's the energy analyst at ICICI Securities. He joins in to give us his view. Prabal, overall, after pouring through the numbers for about 12 hours, what has your take been, and how do you see the stock move?
Well, I think the numbers are again fairly solid. That's not really changed over the last 3 to 4 quarters. I think we have seen that that's the benefit that Reliance gets of having such a diversified business mix, that any one business's weakness, which in this case was the OTC segment, as you mentioned, because of the shutdown of several key units in one of the refineries. That was completely offset by the kind of strength that was shown in the upstream business because of the improvement in production, as well as, the continued momentum in the retail, as well as the Jio businesses. So to that extent, I think the results were pretty solid. One thing that, also stands out, of course, is the fact that, CapEx has reduced quite a bit in this quarter. We'll have to see whether that kind of a slowdown sustains, because remember that the management has mentioned that some of the new energy facilities will start to get commissioned by the latter half of this year. So we'll have to see what the renewed capex run rate is over the rest of FY25. But if this is the beginning of a trend in terms of what the capex run rate is going to be, I think that will be a keenly watched monitorable, because that directly impacts the kind of net debt levels that you are sort of building in for the rest of the year. Those have been persistently high, for a fair while now, and if there's a from a flattish level now, if there's a sustained decline that starts to happen, then you're going to see that improvement coming through in FCF yields, return ratios, and whatnot. And I think that to me will probably be the biggest monitorable over the next 12 to 18 months.
Okay, thanks a lot for that, the overall, estimate on the numbers. But I just wanted your view on the stock as well, if you want to give us a target price, because the stock is at a good run. It's now, 5% away from its 52-week high. Do you think, given the steady business movements across the consumer-facing businesses, oil and gas not too bad either, can the stock sort of surpass those 52-week highs?
Honestly, to be honest, we are still reviewing the numbers. We have not released our update yet, so I won't be commenting on what our revised numbers are at the point. Before the results, we sort of had a target price of around 26 or 100 rupees with a neutralish rating on the story. So I think there are two things that can probably drive the stock. One is, of course, the visibility on new energy businesses. I think will be keenly watched, and that can be a good trigger over the next 12 months for the stock to move forward from these levels. The second, as I said, movements on net debt as well as return ratios and for FCFs, how that plays out. The third factor, I think, would be one of the things that the management did mention with respect to the OTC business, which still does drive cash flows to a certain extent, is that the petrochemical business continues to remain muted, while Reliance still does far better than any of its peers in the global markets because of the integration that it has across its downstream businesses. But overall prospects for the petrochemical businesses continue to be much more muted, and therefore that can offset a little bit of the refining strength that we are seeing over the next 2 years. So these three factors, the story around retail strength, the story around improvements in geo, I think those are something that will continue to be there and are probably built in to consensus estimates to a certain extent. But these three factors...
Since you're talking about positive surprises, there's one more, right? The wireless broadband services will be available across India now in the next 6 months. And the expectation is that there could be a jump in subscriber additions because of that. So there's a surprise waiting perhaps on the telecom business as well, you think? And will you add that to your, target price?
Honestly, our telecom team does build that in to a certain extent. And if I look at the ARPU estimates that we have, not only in terms of subscribers, but more importantly in terms of blended tariffs, since the pricing of some of those services, particularly in the tier 1 cities, is obviously going to be at a premium to normal mobile ARPUs. So once you factor that in, blended ARPUs should continue to improve quite sharply over the next 2 to 3 years. I think our base case estimates build in about 200, 210 to 220 rupees going through for FY25. So as and when that plays out, that's definitely going to sort of positively impact the stock.
Okay, we'll leave it at that. Thanks a lot for joining in, Prabal, and giving us your quick thoughts. So there is a decent set of numbers coming through and lots of positive surprises perhaps in the offing as well. Just wanted to take a quick look at some stocks. Let's look at Paytm. There, as we were telling you, the EBITDA improvement continues. The losses have gone down. There's a CLSA upgrade as well on Paytm. So that perhaps is one stock in pre-opening. It's up almost about 2%. So keep an eye out on that. You have Kotak Bank and ICICI Bank that will be coming out with numbers, and both those stocks are in the green. Remember, IndusInd Bank surprised with the net interest margins being on the positive side. Post that, there is a little bit of positive sentiment in the other banking names as well. HUL from the frontliners is one stock that could be under pressure this morning because of weak numbers. And one pocket I'm looking at, because there's the big Ram Mandir opening that you have on Monday. All of these travel and tourism stocks, right? Whether it's Indian Hotels, whether it's IRCTC, a couple of smaller names as well, Indigo too, all of them are seeing traction.
Well, and all these railway-related stocks, Sonia, they're just, on fire. No one is pulling the chain at all to stop the train. You have RVNL, that's higher in today's trading session. IRFC, as you said, that one as well is higher in trade today. So quite a few of these names, they're moving higher, and they're moving higher on good volumes. Even Dhanlakshmi Bank is coming up with some big volumes. For the week, it's up close to around 24%. And in today's trading session as well, it's up close to around 7%. But Abhishek's with us, and he's going to run us through or give us a quick revision of Paytm's numbers. Abhishek.
We have CLSA on Paytm. They have upgraded the stock to buy from outperformance, and they have increased the target price a bit to about 960 per share from their earlier target price of 925 per share. They say that now Paytm is trying to diversify because BNPL is coming down. So companies are diversifying more after the scale back of BNPL that they did in Q3 FY24, which CLSA expects to continue in Q4 FY24 as well in terms of reduction in BNPL. So they say that company will try to offset the bulk of BNPL business lost by revenue streams that they are finding in new revenue streams, cost reduction, etc. So companies pushing higher ticket size personal loans in lending, and they plan to add another 5 to 6 partners over the next 6 months with respect to this. So high ticket PL will be more difficult to scale up as per CLSA view. They have increased the core EBITDA estimate by 3% over FY25 to 26, and Paytm is looking to grow in stockbroking as well as mutual fund distributorship. So Paytm can make it big in derivatives trading as well as what CLSA has written. Back to you.
All right. Thanks, Abhishek, for that. Z, by the way, I just want to quickly point out, has issued a clarification. Z was down 7% by close yesterday. It's issued a clarification on reports which claim that Sony board will take a call on the $10 billion merger with Z Entertainment today. The company says that they're not aware of and cannot comment on any board meeting held or proposed to be held by Sony, and is committed to the merger with Sony. It's working towards a successful closure of the proposed transaction. The proposed merger, companies engaging with Sony to discuss the extension of the date required to make the scheme effective. So that's coming in from Z at this point in time. I mean, day before yesterday, the stock had a big 6% up move. Yesterday, it sold off 7%. Kind of jumpy on this one. Traders are really all over the place over the last 2 or 3 trading sessions now.
Oh, absolutely. Let's take a look at the first tick on the index. Then remember, the Nifty has been, steady around the 21,700 mark. And that's where we're at this morning. The first tick on the index is up in the green. And in fact, 70 points higher now. Not too bad at all. Sensex is up about 210 points. Let's take it straight to the top gainers. The Nifty Bank, by the way, is also holding up with a gain of 0.6%. And what's leading from the front this morning, the advanced decline ratio, by the way, is quite healthy at 1,094 stocks on the advancing side. Let's take a look at Reliance, HUL, and how they're reacting to numbers. Reliance, remember, the numbers largely were flat in line with estimates. So the stock is flat as well, not doing anything. HUL is the one that's dragging down almost about 3% because the numbers were weak. And the management said that the demand environment is challenging. Paytm, on the other hand, is the one that's up almost about 3%, reacting to a good set of numbers. Losses have gone down, EBITDA has improved, so Paytm looking good. And IndusInd Bank is also seeing some follow-on buying in its numbers after the kind of, in the stock, after the kind of numbers that it posted. So IndusInd Bank is up and about. Would be helpful to see what ICICI and Kotak are doing, given the kind of, given that today both will be coming out with their earnings. ICICI Bank up 0.4% and Kotak up 0.3%. IT stocks are also in focus. Tech Mahindra is holding in the green, and a couple of other IT names also looking good. And then you have names like HDFC Bank. After being one of the biggest losers last week, HDFC Bank is finding some stability, finding its feet around that 1480, 1500 mark. So those are some stocks in focus. In the broader markets, names like CESC, Tejas, etc. are under pressure. Nigel will take that forward. But for now, the opening is pretty decent. Let's see if the market is able to build onto these gains. But for now, green on the screen.
Well, that's right. CESC, that's a big loser. That's down close to around 4.5% in today's trading session. On the flip side, you have some big gainers. IRFC, what do you say about it? 175 rupees stock, 8% higher. RVNL, that stock is up 6.5%. Big move being seen out there. IRCON, up close to around 6.5%. So massive move is what we're seeing out there. EIL, I recall that around 200 rupees, Nimesh was talking about a potential big order that's coming in there. And we had highlighted this as well on Chartbusters, that the way the stock was moving, and we discussed this with Prakash Sivan as well, that maybe, past few years, it's been a bit of an underperformer. But that one, in fact, is bucking the trend. And I think in the last 20 days, it's up close to around 20% approximately. So big move is what we see on that one. NBCC as well, that one is up close to around 3%. And NHPC up close to around 3%. So quite a few big movers is what we're seeing in trade today. And to give you a data point on the Nifty Bank, we're moving towards the 50 DMA. That's around 300 points away from current levels, but it's closer to around 46,000. So that's good news. And on the Nifty, we have opened above the 20 DMA. So that's the other data point that I want to throw in there. RBL Bank will be joined by the management soon, but that's up 3%. Prashant.
Well, it's a good start, right? 75 points higher is what we have. The day's high, by the way, is 21,720. So, that 50% retracement is 21,704. So, marginal crossover, throwover above that level. And then we've come off a little bit. But good. The question is, will around these levels, 21.7 and then 21.8, will this fizzle out or, this is it and we've kind of put behind the midweek turbulence that we saw earlier? We were talking about, and we put that question to Mitesh earlier, some 12-odd PSU stocks, right? We can have, if you can pull the hot boards up, it'll give you a snapshot picture of what's happening across that pack. And you'll get a real sense of what's happening. Nigel was mentioning about some of those stocks, but maybe if you can have those, those sort of stock stacks up. RVN, there you go, on your screen. This is the pack, right? RVNL, IRFC, IRCON, big gains between 7 and 11, 12%. Railtel, RITES, 5%, 3.5%. And then the ex-railway stocks, but PSU ex-railway stocks, HUDCO 3%, IRDA 6%, New India Assurance is up about 3% or so. There'll be more. There's NBCC 3%, REC is a little starting 0.5% higher. GICRE went up massively yesterday. It's up another 3.5%. So this is the pack to really focus on. And, it's just absolutely incredible. What I suspect perhaps is happening, there is, of course, a lot of retail and HNI participation that's essentially predominant here in this space. But I think not today, because, mutual funds are not working. But overall, I think there has been a fair bit of fund pickup as well, fund activity pickup as well. Guys, if you remember, on our birthday, the CNBC-TV18's birthday, on the 7th of December, we were speaking with Sridhar Shivaram.
Yeah.
And we did that chat from the newsroom floor. And he said, well, the idea would be not to try and pick this or that in the PSU space, but buy a PSU fund.
Yes.
And I was just looking at from that day, the index is up some 16%. Wow. On the 7th of, So, I think there is that, because there are fund houses now offering specific PSU schemes.
Yeah.
So I think a fair bit of, and they are getting money every month, right?
Sridhar, in fact, a year and a half ago, he was on our show Smart Money. And at that time, nobody was touching PSUs. And at that time, he said, this is the time when you should be buying PSU stocks. It was a brave call, to be honest, at that time, but it did extremely well. And now just look at where it's
I'll just chip in with the point on PSUs as well. And I did this piece on Editors Roundtable. 3 years ago, the entire PSU basket was 15 lakh crore rupees. Today, it is around 55, 56 lakh crore rupees. But at that point of time, the entire pat that you were getting from those PSU names was around 1.5 lakh crore. So you're saying, yes, the market capitalization has gone up by close to around 4.5 times. But in fact, the earnings as well have gone from 1.5 lakh closer to around 5 lakh crore odd. So that valuation, if you're talking about on a PE basis, this is the entire space, right? Put it all together. It's still trading at that same 11 times, 11, 12 times. So the PE re-rating has not happened, if at all it had to happen. Earnings have gone up in proportion with the prices. And that's just.
Just one more thing. You were talking about Nimesh did a piece, and we put that up. We did that on Editors Roundtable yesterday. That over how P multiples have moved over the last many years, right? But the point is, I was looking at this Kotak note, and what they do very nicely is they give you what PEs were starting 2011. And you look at across sectors, everything was 14 times, 15 times, everything is now 30 times, depending on what sector you are.
Yeah.
So it's just that PSUs have also done well, and they've also gone up. But I think there is this aversion, right? The mental makeup with regards to PSUs as well. PSUs, these are the guys, and the general kind of perception is these are the last things to move in a bull market. It signals this or that. So that's been traditionally how they looked at. But I think the point is that profitability has also gone up quite a bit, as you said. So I think one needs to make account for that and not just kind of fall back on easy explanations, which is that P multiples have gone up because they've gone up for pretty much all sectors across the board.
Absolutely. I just want to make one point on IRCTC as well. That stock is up almost 3.5%. In fact, let's take this question to Dheeraj Agarwal, Managing Director at Ambit Investment, who's joining in now. Dheeraj, this entire space, right? Not just PSUs, we're also talking about how there's now religious tourism, which has become a big thing, and, names like IRCTC benefiting from both those themes, right? What do you do here if someone has missed this rally entirely? Does it make sense to take fresh positions here?
Well, if we're talking about the PSU as a basket and not just IRCTC in particular, I think PSUs as a basket were almost trading at bankruptcy valuations in 2020. I was actually tracking the price to book ratio for the BSE PSU index. And 2019-20, the price to book was 0.6 to 0.7 times for the entire PSU basket. A number of companies were offering dividend yields of double digits, 10 to 12%. And at that point of time, the usual investor refrain used to be that many of these companies, the terminal growth or terminal value is zero. So the price to book or price to earnings, the dividend yields don't matter. That narrative has totally changed now. And I think that there are more legs to the entire PSU rally. So from 0.7 times price to book, the BSE PSU index is now 1.6 times. The previous peak that we have seen in 2007 to 10 cycle was almost 2.7, 2.8 times, almost close to 3 times price to book. I don't know if it goes there, but I mean, who knows? The second thing is that every bull market, if you notice, there is one or two asset classes which actually keep running till the time it enters some sort of a bubble or a hugely overvalued zone. So the previous bull market was driven by quality. The current one is driven by PSUs, a bit of capex and mid caps. So I think there is more to come.
Okay, Dheeraj, hi, good morning and good to see you. Well, this market doesn't oblige consensus, right? And the consensus feeling at the start of this year was banks will do well. And if banks have to do well, what about the largest bank in there? Shocker coming in last week, right, from HDFC Bank. Now, the point is that maybe lack of positive triggers, but is downside limited from here? And would you look to get in at these levels, given the valuations, given the pedigree, given the quality of the bank?
Even I was on the camp that banks should do well this year, given 1 year of underperformance. In fact, last month on your show, I said
yes,
banks should come back this year. But I'm questioning that view at this point of time. And in fact, almost doubting it, because the few results which have come out very clearly show that there is tightness in liquidity, which is showing up in banks facing difficulty in growing the deposit book. So we have known this for a while, that the credit growth has been stronger than deposit growth. The deposit growth needs to pick up in order to either maintain the credit growth or the margins will have to take a hit. This is now finally playing out. So I think there will be some more adjustment time for this process, either through some more margin contraction or even credit growth slowing down a little bit. So best case, I think banks bouncing back is now pushed to second half, if not next year.
Got it. Dheeraj, hi, good morning. Good to have you here. Just a quick word on IT services, where, if you look at growth expectations, right, except maybe a Persistent or a Tata Elxsi, if you look at pre-COVID growth, 3-year growth pre-COVID, all the way till 2019, and look at growth estimates for 2024 to 2026 or so, except these 2 or 3 names, and throw in a Cyient there as well, growth rates forecasted are actually, meaningfully lower as compared to the pre-COVID growth rates. What's your sense on this pack?
So in the last 1 month, especially, IT has benefited because banks have come down. So remember, we are seeing a very clear pressure on consumers, especially FMCG. So we saw HUL results yesterday with the volume growth of just 2%, and we've been listening to the commentary for the last 3 or 4 quarters now that rural will revive at some point of time. But at this point of time, there's a lot of skepticism and disbelief out there. So keep FMCG out. So that leaves only 2 large sectors, IT and banks. And this has actually been happening in the market for 4 or 5 years now. If one sector is under pressure, the second one automatically sees some inflow. So, but you're right, growth is under pressure for IT. I think the big sort of the judgment day for IT is going to be the December quarter results, when there will be a much better sense on what the budgets for next year look like. There is still a divided house at this point of time on the street. Some people think that the growth will rebound in FY25. Some people think it will not, or not by meaningful margin. I would tend to be slightly in the second camp, because if everybody is expecting the US economy to slow down and the rate cuts to happen, it's difficult to envisage that IT growth will pick up in a very strong way.
Okay, well, for the market, the mid-cap end of trade is really surging right now, 350 points higher. And look at the way stocks are moving. RVNL is up 10%, IRFC is up 9%, IRDA is up 9%. The entire PSU basket is looking pretty good. Particularly, Dheeraj, I mean, just coming back to, we spoke about the PSU basket overall, but coming back to some of these themes, there's the renewable energy space, right? IRDA has had a fabulous run since listing. There's the railway space particularly. Do you think that it's too late to get in here, or do you think there's more scope now?
A few of the specific names, one has to look at the numbers and the valuations and be a little careful whether we're already discounting 6-7 years of good performance this year itself. Overall PSU theme, I've clearly said that I think there are more legs to it, but with each individual name, when a theme plays in the market, I'm happy to consider that the stocks will go into a little bit of a bubble zone. So I really like George Soros' quote when he said that when I see a bubble forming, I rush in to buy, add some fuel to the fire. So that might happen. We've seen bubbles forming in other parts of the market in different cycles, different bull cycles. This will also eventually form here because this has become the darling of the market. But I'm not commenting on each individual name whether they're buys or sells here. One will have to take into cognizance valuations with respect to earnings growth.
Okay, all right. Dheeraj, well, good speaking to you, Dheeraj, today. Thanks so much for joining in on a Saturday morning, giving us your view on various sectors. Wishing you a good Saturday ahead, and let's hope this trading session continues to, be as strong, because we have a fair bit of green on the screen. Well, Hindustan Zinc, that's the other one that came out with its set of numbers yesterday. The key positive for it was that the cost of production has fallen by close to around $200 per ton in the last 4 quarters. And that's something that the street liked. In terms of, the float that's available in the market is very limited. Vedanta has 65%, Government of India 30%, and a couple of institutions have 2%. So basically, there's only around 3% float in the market. But to understand what went on in the past quarter, and more importantly, this cost of production is looking good. What's the way ahead from here on? We are joined by Mr. Arun Mishra, the Chief Executive Officer at Hindustan Zinc, who joins in on the show. Hi, Mr. Mishra. Good morning, and thanks so much for joining in. Well, zinc prices have recovered sequentially, but part of the West is still a little bit sketchy in terms of growth and demand. What does this mean on outlook on zinc prices?
I think looking at Europe, recovery has not happened, and I think Europe will remain largely muted even in this quarter. The US is doing well and will continue. China has not fired its engines the way we thought it would, with the government announcing spending on infrastructure and all that has not happened. So in all probability, next quarter also, we would see a range between 2,500 to 2,600 only. Most probably between 25 to 2550 kind of a number, unless suddenly China starts consuming or, in a big way. So it will remain, I think next quarter also we'll see a number 25 to 26 only.
So you're gradually ramping up your capacity. Can you give us a couple of guidelines? What kind of annual rate are you going at currently? How do you see yourself ramping up towards that 1.2 million tons by 2025? Give us any kind of timeline on how you see things improving.
So currently, if this is a mined metal capacity, we are absolutely at the level of 1.2 million ton of mined metal capacity we have. Finished metal capacity, this year we will meet the guidance. However, next year is the one when we will actually be trying out about 1.2 million ton of metal making capacity. It depends upon the business plan that we produce. We are currently working out the business plan. It will require quite a good number of low investment, quick payback, debottlenecking kind of projects to be completed. And so we are working that out.
Right. So talking about the silver fumer has got commissioned. What are the odds you sort of beat the guidance you've put out on board since the fumer plant is finally commissioned?
We are not changing our guidance on silver as of now, although fumer has been commissioned, but it has its own teething troubles. We guess it will stabilize in quarter 4. We are supposed to produce 30 tons of silver in a year. So if we get 1 quarter benefit, it would come to about 6-7 tons of silver only. So I'm not adding much to the guidance that we had given. Will remain largely at the guidance. Of course, next year when we do the production numbers of silver, we will see a better number than what we have produced this year.
Well, Mr. Mishra, Coal India is ramping up production, so sourcing as well for you would be much better. Give us the current sourcing mix. What is the desired mix? And how much are you getting of what you want?
So from last year, last year, quarter 3, our cost was quite high. And from that, we have come down by about $200.
in this quarter, largely because we took structural steps in between. As I promised last year, our power plant were ideally designed for 23 to 30% of domestic coal only. We have modified the ESPs of the power plants, and now we are able to consume up to 45% of domestic coal. And it has helped us to reduce cost of power very, very drastically, and which is reflecting in the overall cost of zinc production that has gone down by $200. It will continue. We will, depending upon the availability, if I give you the number, in quarter 2, we had 45% of the mix was domestic coal. In quarter 3, however, it dropped to 30% based on the availability of domestic coal. So we are ready as long as Coal India is able to supply us more and more domestic coal. We can consume up to maybe 50%, and the power cost will reduce further. Next year onwards, we will start getting the RE power, which will again reduce the power cost. So we are looking at structural cost reduction and journey to $1,000 kind of a number going forward, maybe year next.
Since you mentioned $1,000 per ton cost of production, Mr. Mishra, by when do you get there?
This quarter, we are at about 1,095. So we are quite close. Less than 1,100 number now we have come. So it's just maybe next year when the RE power comes and coal quantity increases, we should be close to $1,000 by next year.
So is there any fresh proposal to buy Vedanta's international zinc from HZL?
We are focused on growing Indian business, and Hindustan on the zinc international business. We have recruited a very capable CEO to run that business and grow that business. So they are growing on their own, and also our copper mines in Zambia starting up, but that's for Vedanta to comment. As far as Hindustan Zinc is concerned, we are not currently looking at acquiring that property anymore as of now.
Well, your shareholders will be happy, if you're not going to be doing that. But give us some more details. By when can we see action on that segregation of entities like silver?
Our design is ready. It's not an issue. And for Hindustan Zinc, segregating into 2 different businesses, zinc and lead and silver separately, is very much easier because the ownership pattern doesn't change. Most of the silver comes from SK mine. Most of the silver gets produced through Dariva smelter. So assets are also earmarked. It's just working through the papers. As far as ownership doesn't change, government's holding doesn't change, flow of dividend doesn't change. So it's much easier work than what we think.
Mr. Mishra, give us a little bit more. Give us a timeline. By when will you be able to close out this segregation of businesses?
We should get government's nod by next board meeting, which is in April, and then by first quarter, we should be able to close the work.
So by when will you be able to close this segregation exercise?
Our ability to generate cash has not changed. It's a question of without spending the cash and keeping the cash in cash reserve. So now we are also investing in a growth project, like we are putting up another roaster, we are putting up fertilizer plant. So all that investment we are making, at the same time we have given dividend. Our ability to generate 49-50% EBITDA does not change. We are one of the lowest cost producer among the top 10 zinc making companies in the world, and we'll continue that cost position. So nothing changes as of now. Giving dividend, not giving dividend is a matter for the board to decide. I will leave it at that.
But you'll have to give us some outlook for FY24 on the dividend front, that given that there's now no big cash balance on the books.
That's for government to decide. To me, if you ask me, if we allow the demerger to happen first, then perhaps the disinvestment of the OFS will be much easier to disinvest part of silver company and part of zinc and lead company separately to separate set of buyers.
All right. Thanks a lot for joining in. Appreciate your thoughts. By the way, the market's still holding up quite well, and big moves coming into the PSU names yet again. When we come back from the break, RBL Bank will be on our radar. R. Subramanian Kumar, who's the chairman of MD and CEO of RBL Bank, will join in to put focus on their Q3 earnings. Stay tuned.
Welcome back. Things are looking good, but could have been better, right? I mean, we started higher and we've got about 50 odd points left. After a crossover of the 21,700 mark, we are 30 points under it at 21,670. But earnings, of course, are keeping us busy. RBL Bank is the next we're going to talk about. The third quarter earnings came in slightly below street expectations. Slippages have gone up. They're about 3.5% or so. Asset quality has deteriorated. Retail loan growth momentum looks strong. We have the management, Mr. R. Subramaniam Kumar, Managing Director and Chief Executive Officer at RBL Bank, joining us to take some questions. Sir, good morning. Great to have you with us here. It's always a pleasure hosting you here on CNBC-TV18. Prashant this side. Just talk us through some of the basic hygiene aspects. One, that provision against AIF investments of a little over 100 crores or so. I think that has curtailed sort of profits in the quarter, returns in the quarter. Talk to us a little bit about slippages as well in terms of, what is the breakup that you saw?
Good, Prashant. Thank you. Good morning to all of you. So first of all, this quarter has been an exceptionally great quarter for RBL. And some of the parameters, especially in the profit parameters, if I just set aside the AIF for the minute, the PAT grew by 53%. And sequentially also is grew substantially high. And ROA was as per the guidance at 1.03. However, the AIF should be looked from slightly a different angle, because this is a new direction which has come from the regulator in respect of the investments made in AIF. If the downstream, the AIF has given to the borrowers, if the customers are common between the bank as well as them, we have to either liquidate it or you have to provide for. The time available was 30 days, and you will definitely agree that it is too short a period for such a liquid fund is to be taken care. However, our investment in AIF is to be, it is a long term, it is highly disinvested funds where we have gone in. Our exposure is only 4 to 5% of the total. And we have the relationship with all these funds for the last 8 to 10 years. And we don't see any stress in those assets with which we have also been exposed to, where the AIF is also exposed. And it is extremely diversified fund. And nevertheless, we wanted to be on the right side of the direction. So we went in for the provisions of 115 crore, which is out of total 121 crores, which we have invested. 115 is eligible or entitled to be provided for, which we have provided. So if suppose I keep that aside, the profit growth has been exceptionally well. Now coming to the point, what we said about the slippage. First of all, the slippage is not alarming. Yeah.
So, sorry, just the slippage, before the slippage thing, you said AIF investment is 4 to 5%, you said?
No, the AIF investment in the funds in which we have invested, our share is 4 to 5% out of the total fund size. Okay. It is not ours. Okay. Ours is total 121.
Yes, that's what I thought. Yes, go on, sir. Go on with the slippage number. Yeah, the slippage breakup.
Yes, Prashant. See, as far as the slippage is concerned, it isn't alarming. There are two major reasons why the net slippage has slightly went up and the gross slippage has slightly gone up. It is in respect of the two factors, that is our credit card and microfinance. And we were a little prudent in respect of expanding the unsecured portfolio in 5 states, especially in microfinance, where it was put into elections. And that really, the growth was flattish. That's number one. The second, the recoveries in, because the festive season and all of the disruptions in this, some of these states, our recoveries were not to the extent what we have been planning for. However, in the month of December, we revived back. Our collection efficiency has gone back to our plan of 99.4%. And in December, our microfinance collection is 99.4, leaving a very little for forward flow, and that is under control. Similarly, in respect to the credit card, also bounced back to that recovery position and the collection position as we have been doing it before Q3. As such, this small 0.62% of the net slippage isn't alarming. We are pretty confident that whatever the recovery we will miss to do it in the Q3, we'll be able to claw back in Q4, and we'll be back to our the normal position. However, when I just relate this slippage to the credit cost, we are well within the range of guidance. We will be in the credit cost between the 1.5 to 2% of the guidance what you have given. At the maximum, it will swing between 1.6 to 1.8, and we are confident of maintaining the credit cost guidance as well.
Okay, so confident of maintaining your credit cost guidance as well. Mr. Subramaniam Kumar, good morning. This is Sonia here. Right. I think what really worked well is that the retail loan growth has been very strong this time. I mean, just look at the numbers, 33% year on year. Is this a loan growth that is sustainable over the next few quarters? And what has led to such a sharp pickup in retail loan growth? And what's the outlook for the full year?
Morning, Sonia. See, we have guided right at the beginning of the year itself that our focus is going to be on a retail and more so on the secured retail. We created a complete structure for that. The first what we did, we created a product which are not on the shelf of the bank. All these products were taking a time for establishing systems, procedure, processes, and keeping people on the floor. That took around a couple of quarters. And now all of them have started picking up. For example, if I tell you, my total disbursements in retail is around 6,000 crores, which was somewhere around 4,000 crores 2 quarters before, and exactly a year before, it was somewhere around 2,000 plus crores. It is because of the fact retail housing, retail LAP, that is a mortgage loan, which was one of the major focus area we were able to thrust upon. Since we have originally we started disbursing these loans at 68 locations. Now we have expanded that to 186 locations as we speak this quarter, and which will start paying us or which will enable us to build this portfolio in the coming quarter. So we are confident that we will be able to maintain, will sustain the growth rate in the retail. Our guidance was that the total advances will grow by 20%. Within that, the retail grow in the range of around 25 to 30%. And within that, the secured will grow at 30%, which we are confident of doing it. In fact, this quarter, our secured retail grew by 50%, albeit the low base. And although we may not be able to do 50% quarter on quarter, it will never be below 30% what we have guided the market.
All right. Hi, sir. Good to see you. And Nigel on this side. You said you're confident of maintaining the credit cost guidance. What is that number for FY25?
It is in the range of 1.5 to 2%.
Got it. All right. So that's out of the
range.
That's out of the way. All right. The CD ratio currently for you, I think it's in excess of 85%. Have you heard from the regulator? Has RBI told you that they would like you to bring it down to a particular level? Any communication?
See, we ourselves are conscious about this CD ratio as per our strategic discussions within the board, as well as what we have communicated to the market as well, is that we will be in the range of 85%. When we talk about the CD ratio, I would like to have a different perspective to be seen. We have an option of drawing our refinance for funding our loan growth, and we are also having a long-term effects. These two are long-term and it is sustainable. So when I try to do this refinance, we have seldom made use of it in our earlier avatar. We have just started using that for funding our funding our growth. If I combine the deposit and the borrowings, refinance especially, and the ratio will be in the range of 73%. Having said that, our focus is we have made it very clear that the branch-based deposit growth, which we saw 23% in last quarter, will be able to fund our incremental advance growth of 20%. Hence, we don't see any stress as far as the growing the book is concerned. And our CD ratio will continue to be in the range of 83 to 85%. When we combine the refinance, it will be around 73 to 74%.
Mr. Subramanian, just on that point on branches, right? I remember reading this note from Spark event as the broker, and the analyst there was had written a note basically saying that, the fact that you are going back to branch basics is is going to be a big game changer for you. Can you just explain that point? Essentially, the point was that your branches were essentially were focused on liabilities in a very big way. Most of the advances were coming through DSOs, etc. And now that is going to be it's going to be done via branches. Could you talk to us what change will this make, not just in the near term, but over the medium term? And if this is correct to begin with, go on.
Yeah. See, traditionally, the bank has been using the branches for the purpose of mobilizing the liabilities. So you have a restricted way of doing it. Then we made an analysis and find out we have to leverage this investment which we made it in the branches. So in order to leverage that, we need to have the retail product. So we have just launched the product, around 7 to 8 products which we have launched it. And now all the branch people were facilitated for sourcing the leads for us retail assets. The retail underwriting, risk underwriting continues to be centralized. There is a separate credit department work on it. So all these branches hitherto looking at the liability as a source of mobilizing in their area of operation or catchment area, they are now started working on. Just to give a pointer, and year before they were not able to generate any leads for retail. Today, out of whatever the monthly logins we get, 25 to 30% of the logins are coming from the branch itself. This is going to provide two things. One, the productivity of the people deployed at the branches is go up, and which will in turn help us to manage our investment efficiently. The second, it will also provide us an opportunity to get the liability people on floor. Asset-led liability is another important strategic move which we have done. And this particular action has given us a lot of positive shootouts. And what we have seen is the number of customers who are being enrolled at the branches has doubled in this quarter over that of the corresponding last quarter, which itself is an indication that the strategic direction is right. In addition to that, what we have done is we have a subsidiary which is having around 1,200 branches. All these subsidiary plus BC put together is having 1,200 branches. And what we did, we identified 800 such locations, which we can leverage for the purpose of sourcing our liability. So now these touch points, we are moving away from the branch base to that of the branch touch points of the RBL, which we have said that. So 800 locations will be provided an opportunity to do the business through digitally enabled savings fund, digitally enabled term deposit. And these, they will be in their catchment area, they will be able to source it. I give a simple statistics. Out of this 800, even if they mobilize at 10 lakhs per month, 800 into 12 months, they will be able to add not less than 4% to my total base of the deposits. So this is an opportunity which we wanted to reap in, and the work has already started. The pilot is has been launched in some of the geographies. We are looking at the system issues and other process issues once it is streamlined in this quarter, and this will be also add up to our ability to add deposits in the bank.
Okay, all right. Final question, sir, before we let you go. Actually, final couple of questions. What is the ROE target that you have for FY 25-26?
Instead of getting into the ROE first, I'll start with the ROA. We wanted to have an exit of around 1.1 to 1.2 this year, and there will be an increase of 20% year on year thereafter. And thereafter, with a leverage of around, let us say, 9 times, you'll be in a position to have at the end of 26, as mentioned document, which we are working on, so around 14% of ROE at the end of 26. This is what we have been aiming at, and we are on track.
14%?
Yes, on 26 FI exit.
20. Okay, got that. And any plans to raise capital?
See, right now, our capital adequacy is well maintained. In fact, this time, even after the sequential growth, we consumed around 65 bips. Even after the regulatory directions of increasing the RWA, we are confident, and we feel with this, we will be in a position to manage for next 6 to 8 quarters the capital sufficiently available with us.
All right, we'll leave it at that, sir. Thanks a lot for joining in. Appreciate your time here on CNBC-TV18. Very optimistic there. That's RBL Bank up about 2%. But 2023 was a great year for the PSU stocks, with almost 34 of them seeing gains of over 100% in the past year alone. Nimesh, our colleague Nimesh, yesterday in our Editors Roundtable show told us how valuations are looking like for the PSU stocks. So let's revisit that.
The PSE index has rallied 81% in calendar year 2023, and they've added nearly 22 lakh crores in terms of market cap. The entire PSU basket has added nearly 22 lakh crores in market cap only in the last 1 year. If you look at the big gainers, the 1/3 of the PSU basket, which is 33 companies, have rallied between 100 to 300%. That's the kind of move we've seen in the PSU baskets in the last 1 year itself. Now, I'll just break into the different sectors now. The first sector I'm picking up is railways. Nobody knows where the train is going to stop, but just look at the rally and the kind of valuations now. I just want to put a word on the valuations. IRCTC, it's trading at 55 times on the current year valuations. Ircon, which has been the big mover, that's now trading at close to 18 times. RVNL close to 32 times, and RailTel is now trading at 35 times. I don't have the 5-year average for these companies, but this is the kind of valuation you're giving for the railway PSUs now. Next is, look at the capital goods space. BHEL, that stock is, after rallying 155%, is now trading at close to 50 times. We don't have an average for that as well. HAL is now trading at close to 31 times versus a 10-year average of just 10 times. RITES is trading at 20 times versus the average of 12 times. And BEL is now trading at close to 34 times versus the 5-year average of 16 times. So that's the capital good basket, how they are trading at after the big rally in those stocks. The third is the power stocks. Look at the power stocks as well. NTPC, NHPC, SJVN and Power Grid all are now trading in double digits multiple for current year valuations versus the 5-year average of all were trading below they were trading in single digits. Now all are into double digits. SJVN is now trading at 22 times on current year price to earnings. Now look at the finances of the PSUs. IRFC, the biggest mover of 2023, that stock is now trading at 4.2 times price to book on current valuations. I don't think many of the even private banks are not quoting that sort of valuations. REC, PSE are almost at 2 times now, which historically they've been trading at just half time in the past. So it's been a big move in terms of the power PSUs as well. Now look at the banking. This is an interesting chart. The PSU banks, despite the rally, look at the valuations now. SBI trading at 1.4 times, the historics around 1.4 times. So it's not trading at exorbitant valuations. Bank of Baroda, Canara Bank, all trading close to one time price to book. And historically, they've been close to one time or half time price to book. So in terms of valuation, the PSU banks are still not very, very expensive even after the rally. And same is the case with the OMCs as well. Look at the OMC stocks. They all have rallied and the momentum just continues. But even in terms of valuation, HPCL is now trading at close to 8 times. Historically, it's been trading at 4.5 times. BPCL, after the rally, is now still trading at 8.7 times, whereas historic has been around 10 times. Same is the case with IOC as well. The only outliner in that OMC basket is Chennai Petro. That is now trading at close to 8 times on current year valuations versus the historical average of around 2 times. So, again, as I said, the entire basket has done really well. The PSC stocks have added nearly 22 lakh crores in market cap, but keep an eye on the valuations. Some of the stocks are now trading expensive than even the private company stocks.
Interesting piece as always by Nimesh. And just to give our viewers one more data point, the total PSU market capitalization as we speak with the movement in today's session is at 60 lakh crore rupees. And to give you a context, 3 years ago, it was 15 lakh crore rupees. So 3.5 years or so ago. So there's been a big surge in terms of PSU market capitalization. 60 lakh crore, that's the latest number that we have post these big moves that we're seeing. But let's get you another big voice. Apollo Hospitals has launched its first AI-powered oncology center in Bengaluru and plans to expand with 25 more AI-run centers across the country. Ritu Singh caught up with Sunita Reddy, the managing director at Apollo Hospitals, and began by asking her the investment plan for this initiative.
We've invested 8 crores in this center, and we plan to open another 25 centers across the country.
Okay, and what kind of investment would be going into opening 25 centers like this?
It's 8 crores for this center, so we just multiply it, maybe 160.
I see.
Over a period of time.
How affordable is this going to be as a treatment, for the, even with insurance, etc.? What's the typical cost involved here?
It could, it varies from different protocols and treatment types. So it's very difficult to give you one answer because, like I said, every human being is an individual, comes with a different DNA and a different problem.
Okay.
So I think you should look at, typical cancer treatment could be somewhere in the range of 1.5 lakhs.
If I could get a general perspective, since we're starting the new year, what kind of occupancies you're seeing, what kind of trends you're seeing there during the quarter?
You're going into business now. Now we're seeing good occupancies, and I think more of this post the board meeting.
Oh, okay.
But very healthy occupancies, especially in Karnataka.
I see. But your hospital revenue, your pharmacy expansion, in any sense you could give us about the trajectory that you see starting this new year?
Let me just say that it'll be a very strong trajectory. And it's so strong that we are now investing in creating additional capacities.
What would that entail? You have about 70 hospitals, 10,000 beds, 6,000 pharmacies. To what extent are you looking to expand each of these?
So in the short term, which for me is 3 years, 2,000 beds.
Okay.
And 3,000 crores of investment.
And, would you be raising capital for that? What are the capex plans for this year? And, would there be any private equity investment involved? We've been seeing that trend across healthcare.
Thankfully, Apollo has very strong cash flows to fund expansion.
Okay. So what is your capex plan for the year, if you could share for us?
I said over 3 years, it's 3,000 crores.
Okay, well, that's, Apollo Hospital's commentary on the business as well. The progress in railway expansion and modernization is huge, says the Minister for Railways, Ashwini Vaishnav. Speaking with my colleague Shireen Bhan from the sidelines of the World Economic Forum at Davos, the Minister outlined expansion plans for the railways. I mean, stocks have been flying high in this space. Listen in to the Minister.
Let's also talk about railways. And you said that you had meetings with the Swiss authorities here, but I also wanted to understand from you, in terms of the ambition and aspiration now as far as railway capex is concerned, as far as building on the project momentum is concerned, what's the view, what's the road ahead?
See, the progress in railway expansion and modernization is huge. For example, last year we added 5,200 kilometers of new tracks. That's like adding the whole network of Switzerland in 1 year. 5,200 kilometers. This year we are doing at a pace of 15 kilometers a year. So 15 kilometers a day. 15 kilometers a day is like huge. We have just, out of the $29 billion capex that we have planned for this year, 2,40,000 crore, we have already accomplished 77% as on yesterday. I get a report on a daily basis. I monitor it so closely. So we have already achieved 77% of it.
Okay, well, Ashwini Vaishnav, who's also the IT minister, backs the mobile industry's demand for tariff cuts on imported components, also says that Vodafone Idea is making sincere efforts to get investors.
I want to go back to telecom and address the Vodafone issue with you, because when we last spoke, you were hopeful that they would have been able to get investors on board. That hasn't been the case. The government continues to be the largest shareholder in Vodafone. Is that something that you are looking at today?
I think they are making their sincere efforts, and they've been regularly updating us about what they are doing. And I think we have done whatever we were supposed to do. And I think the journey so far has been...
we were asking the question in the morning whether the rally will fizzle out at about 21,700, right? It has fizzled out, at least for now. So look at what the Nifty intraday seems like. We're just about 10 points higher. So after a start, which basically means we're about exactly 100 points off the day's high, because the high was 21,730. We're at 21,630 right now. So there's been a continuous drop which has happened since the morning, but this is still the first hour and you got the full session ahead of you. Maybe just take a look at the Nifty Bank also, which is still in the green. But of course, there has been a significant give back from the day's high. Market breadth is positive. 1,400 stocks are higher, and you got about 800 stocks which are lower at this stage. Mitesh is back with us, 10 a.m. trades, and just a quick view on the market. Mitesh, looking at the drop-off which has happened, what would you do?
So, Prashant, as I said, I think, we are in a process of consolidation. The markets are likely to chop around, and therefore, I think you will get these bouts of buying and selling during the day. I think that process will continue. Broadly, try to buy closer to 21,300, 350 zones and take a 50-point stop below 21,300 support area, and exit and take profits as we get closer to 21,750. I think that remains the strategy for the next 5 to 9 sessions. And unless until we see a signal of this range getting violated on either side, I think we'll maintain this stance. On the stock side, Coal India is on the buy list. Disclaimer, we have recommended to our clients, so there's vested interest. It's a buy with a stop at 386 for targets of 410. And the other stock which I like is Power Finance Corporation, which is a buy with a stop at 412 for targets of 433.
All right. Thanks a lot for that, Mitesh. By the way, my colleague Hormuz very helpfully sent us this data on stocks like IRFC, RVNL, etc. The gain just in the month of January, right, for IRFC has been 77%. RVNL gain in just January, and we're not done with the month just yet, is 76%. And IRCON is up 47% in the month of January. So it's been a phenomenal month for many of these stocks. But let's do one thing. Let us talk about the overall market. How is investor participation looking like today? No prizes for guessing that one, actually. Surbhi is joining in with all the details. It's a shock and awe sort of situation, Surbhi. But I guess it's just you and me working today.
We're making the most of it, Sonia. We're polishing off some samosas and some croissants in the newsroom. Hopefully, there'll be some left by the time you guys come out of the studios. But, yeah, on a serious note, I was trying to find out from all the domestic mutual funds whether they will really be out there live with their dealing desks, buying and selling, whether trades will happen. And the answer that I got from most AMCs was no. Now, there's no official statement on it, but the word is that, the Saturday's trading session is being declared as a non-business day by AMCs. Now, what does non-business day essentially mean? That operations are going to be shut for most parts of it. There's no mandatory sort of, norm to come in and buy or sell. In fact, a lot of the AMCs and fund managers that I spoke to said that they will not be trading today. And many perhaps won't even be going to office as well. So low participation for today, and not just today, for Monday as well. Monday is also being called a non-business day because anyway the equity markets are shut. And there was one clarification that if anybody is waiting for the redemptions to come through, the payout cannot happen on Monday because a lot of banks are also closed on Monday. So investors will have to wait till Tuesday to get their money if they're looking at any redemptions. And mutual funds are not taking in any money today either. So I think it's a long weekend for a lot of the fund houses out there. But yes, not for you and me. Back to you.
All right, Surabhi, thanks very much for that. So it's a quieter kind of day with local institutions maybe out of it, and foreigners, of course, out of it as well, with this being a Saturday. Let's shift our focus to big bank earnings. Big banks were always going to report today. Just that today's turns out to be a trading session. ICICI Bank will report, and so will Kotak Bank. Abhishek is with us to run us through each of them. Let's start with ICICI Bank, Abhishek. What should we expect?
Well, to start with, it's good that they are giving results on a working day for us. So let's begin with ICICI Bank. Lowest NII growth in 21 quarters estimated by analysts on a YY basis, and sequentially you can expect a PAT decline. So to begin with, loan growth expected to be strong. Kotak Securities estimates loan growth of 18.5% YY and about 4% sequentially. The net interest margin can come under pressure. Morgan Stanley estimates anywhere between 15 to 20 basis point decline in net interest margin on a sequential basis. Provisions can rise quarter on quarter as per Kotak Securities. The slippages also may rise sequentially, but not much. Watch out for where the slippages come in from, either the known stressed accounts or actually the fresh slippages. In the difference between that will actually impact the stock price. Morgan Stanley estimates slippages of 5,250 crore. Last quarter it was at 4,690 odd crores. Asset quality can remain stable or improve. Motilal Oswal estimates gross NPA ratio of 2.5% versus 2.48% in the previous quarter. Watch out for commentary from management with respect to loan growth as well as deposit growth and movement of books, that is watch list about 4,790 crores and restructured book of 3,500 odd crores that will be seen closely. Our polls suggest NII growth of 12.2% YOY and about 0.9% sequentially. We are working with a profit growth of more than 20% YOY and a decline of 2.6% sequentially. Back to you.
Okay, thanks a lot for that. Well, we also have Kotak Mahindra Bank that will be reporting its numbers. What can we expect?
For the entire BFSI sector, Sonia, net interest income or net interest margin is the key area of focus in these quarterly results, given the fact that cost of funds have risen massively. So watch out for, NII growth, which analysts are pegging it to be the lowest in last 8 quarters and profit growth to be the lowest in last 9 quarters on a YY basis. Key thing to watch will be loan growth expected to remain strong. Motilal Oswal expects a loan growth of 16.5% YOY and about 4% sequentially. Deposit growth also can remain healthy. Motilal Oswal estimates a deposit growth of 20.5% YOY and about 3.5% sequentially. Net interest margin, if that remains stable, that will be a key positive. Morgan Stanley does estimate a flat net interest margin on a sequential basis. Need to watch out for the low-cost deposit momentum, which the entire street is witnessing a decline in CASA ratio. Last quarter, it was about 48.5% for Kotak Mahindra Bank. Asset quality can improve. Motilal Oswal expects gross NPA ratio to decline by about 9 basis points sequentially to 1.63% versus 1.72% in the previous quarter. And management commentary and outlook with respect to business growth momentum and other key parameters will be seen closely. Our polls suggest NII growth of 13.7% YOY and about 2% sequentially. We are working with a profit growth of 13.2% YOY and a decline of 0.9% sequentially. Back to you.
Okay, thanks a lot for that. Let's move away from banks now and talk about some of the auto stocks. Shireen Bhan caught up with Vice Chairman and Managing Director of Apollo Tyres, Neeraj Kanwar, in a wide-ranging conversation. Shireen spoke about the FY25 outlook, shared their blueprint for their foray into the electric vehicle sector as well. Very interesting conversation. Listen in.
Well, I think Q4 is going to be a positive sign. We are already seeing positive signs both in India and in Europe. Europe car tires, car OEMs have gone up 7%, whereas truck is still down, agri is down. But I see India coming back up. We are still single digit. We are not going to go to the double digit, maybe next year, next financial year. But Q4 is much more positive than Q3.
Okay, so demand is expected to pick up both in India and in Europe?
Yes.
What do you think are the causes for the kind of growth that you've seen, the slower growth that you're seeing at this point in time?
Well, I think people are being cautious of buying. Interest rates are high.
Yeah.
And so they're holding on to. Supply chain is a big issue today. Given the Red Sea issue also, we are looking at a lot of disruptions in supply chain. Freight costs have gone up by 40%. Time taken on transit is taking up by more than 15 days. So these are some of the issues that people are facing today.
Has it impacted you in any way?
Yeah, big time. I mean, 40% costs are gone up in freight, and the availability of tires is taking 15 days longer. So yeah, there is a major challenge as far as supply chain is concerned.
Is there any way of being able to offset, if not the entire amount, but what could the impact be on account of this?
No, I think it's just an interim issue. I don't think we can overrun the cost of this, but it's an interim issue. I hope that we'll be able to solve it.
So that, of course, is one of the uncertainties that you're dealing with. What are the other key risk factors at this point in time?
Well, right now, the main thing is the supply side. Raw materials have eased out. So that's saving the companies, and the tire industry is doing pretty well over there. One is looking at going into EVs, which is very big. Europe has gone big time into EV tires. We have started launching EV tires in India as well. The biggest risk going forward is going to be carbon emissions. And Apollo itself is looking at becoming carbon neutral by the year 2050. The products also, we have to look at how we can come up with sustainable raw material products. We've already come out with 2 products in the car category and in the farm category with 75% sustainable raw material. So that's going to be a big challenge going forward on how do you use raw materials which are sustainable, how do you come down on carbon emissions. We've taken a target by 2030 we should be around 40% renewable energy.
Okay.
So these are some of the new things that one is looking at and the challenges that one is going to face.
So let's talk about the EV opportunity, and how do you expect that to play out for you? How are you gearing up for it?
Well, EV tire is obviously you need less noise because now it's a battery. You need more torque and you need much more rolling resistance. So companies like ourselves have been doing this for a long time. It's been driven by the OEMs. And so we are ready to take on that. I don't see that as a big challenge.
Okay, let's slip into a short break. On the other side, we'll get you excerpts from our exclusive conversation with the RBI Governor at Davos 2024. Stay tuned.
Okay, welcome back. We're about 30 points higher. So there's we actually slipped into the red, but the pullback has come. But 21,650 is where we're at. Quiet is the word you used to describe the markets today. On the sidelines, the recently concluded World Economic Forum in Davos. My colleague Shireen spoke with the RBI Governor, Shaktikanta Das, on a range of issues, including India's growth potential, its ability to deal with global geopolitical challenges, and also prospects of an impending possible rate cut in India. Listen in to a slice of that conversation.
In terms of macroeconomic stability, macroeconomic growth, in terms of financial stability, in terms of monetary policy actions and their outcome and bringing inflation under control, I think India is today well placed. It showed its resilience, and India is well placed and also well placed to deal with many emerging challenges. But having reached this point, I think what is now the focus, which should now be the focus, and what is our continuing focus, is to maintain that stability, maintain that resilience, and work towards improving it and strengthening it further. India is on the whole doing well, and will continue to do well as per the current indications.
Let me pick up on that comment that you made, and you have called it a period of great volatility between 2020 and 2023. On the back of the conversations that you've had here in Davos, as well as some of the emerging uncertainties, for instance, the attacks that we are seeing on the Red Sea, etc., what is the outlook now as far as 2024 is concerned? Domestic, of course, as you rightly pointed out, much more stable, relatively calmer. But what about the global factors that we will need to be watchful of?
You see, all these global geopolitical flashpoints are evolving. Around the Red Sea region, how it will evolve in the coming days, we have to wait and see. Only the time will tell. As things stand today, India will be able to deal with the existing challenges, but we have to see how it all plays out in the future weeks or months. And this kind of uncertainty, I think, is what is making policy making really that much more complex.
You know, speaking of complex policy challenges, the central banker's dilemma and the central banker's challenge at this point in time is that there is a clamor from industry, from consumers, perhaps even from government to cut rates. But there is a fear and the risk that if you move too prematurely or too early, you could in fact cause more disruption and upset things further. I know you've firmly said that there will be a change in stance or a cut only if we get to 4% on a sustainable basis. But you know, as a central banker, and you've been talking to other central bankers here as well, isn't that the big challenge and the big dilemma for you?
I think, you have partly answered the question. You see, the markets all over the world, the markets are running ahead of the thinking of the central banks. In India, you mentioned that there is an expectation from various quarters about a rate cut and all that. Frankly speaking, the serious players in everywhere, whether it is the industry or the private sector, or it is the analysts or the economists or the serious the market players, in the context of India, I don't think anybody is expecting a rate cut now. In most of the advanced economies, the markets and the stakeholders and the market players, their assumptions, it is ahead, they're overrunning their central banks. So far as India is concerned, I think the thinking of the central bank and the thinking of the market participants, they are much better aligned. In inflation, with regard to inflation, I have said elsewhere that our policy has to remain actively disinflationary till we reach the target of 4% on a durable or a sustainable basis. And that is our current stance. You see, ultimately, why are we working towards this 4% inflation? Because a stable inflation, what we call price stability, provides the support, the required support. It acts as a bedrock for growth, for sustainable growth. Otherwise, you will have off and on data of growth doing well, then again slipping back. And a premature, you are right, absolutely right in saying that any premature pivot in our policy, it can be very, very costly for the economy.
You know, you talked about growth, sir, and the NSO advanced estimate has pegged growth higher than the RBI's estimate. On the back of the data that we are looking at today, do you believe that there is an upside projection or growth could do better than your own estimates?
You see, we said 7% for the current year.
Yeah.
Our earlier projection for current year, that is 23-24, was 6.5%. In October, in end October, when I said, in one of the events and followed up by our monetary policy statement, when we said 7%, our previous number was 6.5%, and I think the market was also around 6.5%. That time, 7% was seen as optimistic. But subsequently, the NSO, that data which came about a month later, so naturally they had a later period data, and NSO has access to several data to which we don't have access. Now 7.3, and in fact in the monetary policy conference, we had said, in fact the Deputy Governor had said that, it's actually 7% is a conservative estimate.
Yes.
So we were expecting that it can exceed 7%, but we wanted to be absolutely, absolutely sure about our number. Even for next year, I have said yesterday that the growth momentum is a momentum of economic activity is well maintained, and next year growth will be touching 7%. And when that happens, for 4 consecutive years, successive 4 years, India would have recorded a growth of 7% or more.
We saw a significant impact on the banking sector, on the banking stocks in specific. HDFC Bank came out with its numbers. There is a concern now as far as deposit as well as credit growth is concerned, and deposit growth not keeping pace with credit growth. Are you concerned about that?
You see, our deposit growth, if you see the last 1 or 2 years, the deposit growth has been around 12 to 13%.
Yes.
The credit growth has been about 15%. Now, obviously, you see, it's not that you get X amount of deposit and you extend that X amount as a loan. It's not like that. Each loan that you extend, money creates money. The money multiplier happens in the market. So, obviously, the credit will be little, will always be little higher. Now the question is whether it is unduly higher or it is sort of has a correlation with your deposit base. At the systemic level, at the individual entity level, at the moment, we don't see any risks. We are doing our regular, our supervision has become much more intense. We have now an ongoing method of our supervision is ongoing. It's not once in a year annual inspection or annual supervision of the banks. So at the moment, the Indian banking sector at the systemic level is very robust. Even at individual entity level, it is very robust with regard to stock prices, the stock market prices. You see, stock markets have their own dynamics, and the prices, share prices in the stock market do not necessarily reflect the fundamentals of a company. I'm talking in general terms, not with reference to a particular bank. Generally, if you see, the stock prices are determined by so many other factors and do not necessarily reflect the fundamentals of a company. You have examples in every sector, whether it is the financial services or banking or any other sector you look at. There are companies with very strong fundamentals, but its share prices should be low. And the converse also happens. So therefore, it will not be correct to, judge the health of a particular sector like banking in particular in terms of share prices, movement of share prices, and that too on a single day.
There is a concern or perhaps confusion as far as the credit deposit ratio is concerned and whether the RBI is likely to mandate a number or not. Could you clarify this for us?
You see, we have not mandated any number. I think there was... let's leave that. But what I would like to say very clearly is that we have not mandated any number that this shall be the credit deposit ratio. We have not, and at the moment we don't propose to, because credit deposit ratio is just one of the parameters to assess the health of a bank. There are several other parameters. So you have to look at it all in totality. All that I can say is that there should not be exuberance in lending, number one. Number two, there should be some correlation between your deposit base and your credit growth. There should be some correlation. But in terms of hard coding it, in terms of a particular number, there is no such proposal in our mind, and we have not prescribed any such number.